Okay, welcome to the October 10th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about what's going on in South America, how planting progress is going down there, the U.S. harvest, and then we'll preview the WASDE report that's coming out this week and wrap up with a discussion about the move in RIN prices and what's going on in biodiesel production. All right, so let's get into it. So planning in Mato Grosso is really officially underway. It's been underway for a couple of weeks now, but last week farmers planted about 10% of intended acreage. You can see that's a little bit ahead of the 5-year average, not quite as fast as last year's progress. And remember, last year, because of the La Nina, conditions were dry, and so farmers could plant basically about as fast as they wanted to. This year, with the transition to El Nino, it's a little bit wetter, which ultimately is better, even if it means they don't get the crop in quite as fast. So right now, I would say, there's nothing really to worry about as this continues to advance. The market will probably take a little bit of weather risk premium out of soybean futures, which it should weigh on soybean oil prices, I guess. But given the plunge we've seen in soybean oil prices over the last week or so, it may be getting to the point where that relationship is probably stretched to the downside about as much as it can. I don't know. I guess I shouldn't really say that. It feels like that. I don't know that there's any real good reason to think that, however. And if soybeans took a sharp turn down, soybean oil prices would definitively follow. Either way, generally off to a good start in planning in the largest producing state in Brazil. We'll keep on this. The one thing to think about, I suppose, when we're talking about this planning, farmers will want to get in, and it's not so important right now, but it becomes important sort of a little bit later in the year. Farmers will want to get this crop in as quickly as they can so that they can plant the safrinha corn crop afterwards. So last year, obviously, wasn't a huge problem given the pace of planting. However, the year before, delays in harvest and planting, I guess, really delayed production or delayed planting of the safrinha corn crop and reduce production a little bit. But at this point, I would say that, the weather is basically as expected, especially for this early in the growing season. And now remember, Brazil is obviously a huge country, and they grow crops from up against the Amazon jungle all the way down to the southern tip of the country. So their planting season is a little bit longer than ours. They started planting on the 15th, or I guess they're legally allowed to plant starting September 15th. And then they'll plant all the way through January. That part of that is also, I suppose, Argentina, but it's a long planting season, and we're just at the very beginning of it. I guess that's really the point. All right, so what do we expect this year? The transition from El Nino to La Nina, as Joao talked about several weeks ago, generally means better growing conditions for South America. However, and you can sort of see it in here, there are some differences in the way that El Nino excuse me, impacts northern growing areas, and particularly if the El Nino is particularly intense, or I think if you have a relatively rapid transition from La Nina to El Nino, which we do this year. How intense the El Nino will be, I think, remains to be seen. But I don't think that there's any doubt about whether we've had sort of a rapid transition from La Nina. It was just earlier this year that La Nina conditions were still present, and I believe that that now there's an official El Nino. I have to go look at my ENSO data there, but if it's not one now, it certainly is headed in that direction, and will likely become one in the not super distant future. So, what these three or I guess six charts show is the relative rainfall during the growing season for a weak La Nina and El Nino, a moderate La Nina and El Nino, and then a strong La Nina and El Nino. And if your Portuguese isn't as good as mine, which is not very good, the Forte is the strong version. So what you can see here is Mato Grosso is the state in the middle there, sort of on the upper right-hand chart. It's the state where the two circles touch. And what the two circles are signifying is drier than normal conditions. And generally, if you look at what happens to yields in years where there's an El Nino and years where there's particularly strong El Nino or El Nino, we have a rapid transition from La Nina to El Nino, is drier conditions sort of as you move further north. And so this is the one concern for this year, is that even though the shift to El Nino will likely improve growing conditions in Argentina, it could have the opposite impact on northern Brazil. Now, I don't think that that means by any stretch of the imagination, and please don't take this way, what we're not trying to say is that the conditions in Mato Grosso will be similar to the conditions that we saw in Argentina last year. We're not talking about that much dryness, more just lighter than normal rain. Probably, I would say, a bit more like the summer here in the Western Corn Belt, this past summer in the Western Corn Belt, maybe even a little bit more rain than that. But certainly enough that I wouldn't suspect that Brazilian yields will be 50% of trend line. And really, outside of La Nina years, I always think that it's pretty tough to bet on weather problems in South America impacting production. In La Nina years, it's a different story. But outside of in ENSO neutral or El Nino years, generally production is going to be pretty close to trend line. Now, as Brazilian farmers expand production further north, then obviously El Nino will have a more significant impact on overall production. However, given that that requires an expansion to the north, you've got more acreage. And so sort of in theory, you might lose a little yield in those acres, but because you've got more of them, you're still kind of producing about what you would have expected to produce anyway. The rainfall so far, particularly in Mato Grosso, has been beneficial for soil moisture levels and early season crop development. So again, not a concern right now, but something that that we'll pay close attention to as the year goes on. And if it does turn out to be a drier than average year in the north, we'll cut our production forecast. However, given our expectations now, we could cut a fair amount out without necessarily triggering a sharp rally in soybean and by extension soybean oil futures. All right, so I wanted to put this up just to kind of highlight again where they grow soybeans in Brazil. Here's Mato Grosso. It is the largest growing state in the country. And you can see there are some major growing areas in Bahia and I suppose, some concerns or potential concerns for Goyas too, although probably to a lesser degree. But that sort of triangle right in there, that's the primary producing region at this point. And it is in the area where, there's risk of drier than normal weather conditions. That said, CONAB expects production of 162 million tons. We're at 166 million right now. However, it's, like I said, it's still really early season, and so we'll adjust. Either way, I think it probably looks difficult for South America to produce a crop that's smaller than last season's crop. Now, if we do have an extraordinarily dry growing season in northern Brazil, then that won't look very smart. But given the fact that you lost about 10 million tons out of Rio Grande do Sul last year, and they still grew 156 million ton crop. If you just add those back, you basically get to our number. And if you add those back and then take some away from the north, you get something that's a little bit less than that, but probably still above the 156 million tons that they grew last year. You can see we've got Mato Grosso in for 44 million tons, or about 25% of production, which matches what the map says, which is nice. Okay, on to the U.S. and harvest progress. So you can see the U.S. is in harvest progress about where Mato Grosso is in planting. Just sort of started making good progress, but not substantially different than the 5-year average. And given the weather outlook, it's a little chilly up north right now, or I guess it is. But that doesn't necessarily slow down harvest. If it's dry, farmers will harvest, and even if it rains a bit, farmers can make some pretty rapid harvest progress when they need to. You can see during this week last year, they harvested nearly a quarter of the acreage in a single week. So if they really want to get it done, or if there are some delays or whatever, they can move it along pretty quickly. Okay, so the last time we'll look at this chart for this year, this shows the last crop condition report from USDA, which was actually a couple weeks ago. But I wanted to put it up because I wanted to talk about the WASDE report and the potential changes to USDA's U.S. soybean production estimate. So typically the way that we look at the month-to-month changes in USDA's yield estimate is by comparing the changes in the crop conditions ratings from the first week in one month to the first week in the second month, which is when USDA is kind of doing their surveys. That's, even though, again, crop condition ratings are not great at estimating the overall level of yield. So you can see from this, if that were actually true, or if crop condition ratings were really good at predicting the overall yield, we would be predicting a yield that was well above or well below where we've been in the last 5 years. And that's not the case. However, it's decent at predicting the month-to-month changes. So if we look at essentially the 52% good or excellent in the first week of September, we compare that to the first week in October, which is also 52. Actually, I think these are off by a week. So the 52 should be over the 1st of October, and actually the 53 should be over the first week of September. So there's a 1% decline in condition ratings, and that implies a 0.4 bushel increase in USDA's forecast, because seasonally the crop condition ratings go down. And so if you have relatively flat condition ratings, it actually implies at this time of the year, it implies an increase. However, if you go back 1 week and you look at the 58 versus the 50, if you get an 8% decrease in the good and excellent rating, that actually implies that USDA would cut their forecast by 0.6 bushels, which based on their September estimate of 50.1 would leave their prediction at 49.5, which is about a bushel above where we are. Again, we're probably a little low on our forecast for production, but after this month's estimate, we will basically, if not adopt the USDA number, get very close to adopting the USDA number. There'll be one more crop estimate in November, and then nothing in December, and then in January we'll get the annual summary, which has really the last estimate of the crop, although they do come back and revise the crop from the prior year when they released the September stocks report. So we're getting close to having a firm number, I suppose, for the U.S. soybean crop. And this is what the changes that they've made over the past 23 years looks like. They've raised the yield from August to September 12 times. So they're at least in the past 23 years, they've been a little more likely to raise the yield in October than to lower it. October also happens to be the largest average change during that period of any of the months. So if you just look at the absolute value of the changes and you take an average, it's about, or I'm sorry, no, this is actually an average. The average is 0.4 bushels, an increase of 0.4 bushels. That's double the size of the 0.2 bushel decrease in the July WASDE, which is the first, or I'm sorry, the August WASDE, which is the second estimate, the first objective yield estimate. All of those numbers really are, they've lowered the estimate from September to October 7 times, and that's been by an average. The increase has been an average of 1.2, and the decrease is 0.8 bushels per acre. We're showing a 0.4 bushel increase here based on, again, the changes. However, our forecast suggests that USDA is more likely to lower the crop production forecast than raise it this month. Personally, if we get outside of what history and the correlations tell us, I think that USDA probably is more likely to leave the yield relatively close to unchanged this month. I think if they do make a change, I think it'll be relatively small. But I suppose we will see in a couple of days. All right, so what does that mean for the U.S. balance sheet, and how does that compare with what USDA had in September? We're not that far away from USDA on either the old crop balance sheet or the new crop balance sheet. For the old crop, we've got basically all of the data now. And so I think USDA is probably going to need to cut or reduce their residual use by 4 or 5 million bushels. And they're going to have to lower their crush forecast and raise their export forecast a little bit. All that'll come out to the 268 million bushel ending stocks that they estimated in the September stocks report released the week before last. On the new crop balance sheet, really our difference is about production and then exports. So we're about 150 million bushels smaller on production, 135, I guess, really, but we're 190 million bushels smaller on exports. If USDA doesn't cut their forecast down to our number, essentially, and we end up raising our forecast, all of the increase in production will go into our export forecast. The 2.325 billion bushels of crush, that's where we're going to stick until we really start to get into the marketing year. After we've gotten a couple of months of crush, then we probably will revise that. It's based primarily on our expectation for capacity in 23-24, and then we reduced it just a little bit. We reduced it a little bit from previously it was at 2,375, which is kind of where we think capacity is. That's always, crush is never right at capacity, and so we cut it a little bit. We raised our export forecast a little bit over the past week too, just because we had the extra beans from cutting crush, and it feels like we probably will export a little bit more than, I think we were down to 1.525, and that felt just a little bit too low. So at the end, we're relatively close to USDA on ending stocks, with the sort of offsetting differences in production and exports, and then minor differences in the other categories, imports and residual use and seed use and all of that stuff. I would say one thing to note about the projections are that both USDA and fast markets expect farmers to increase acreage next year. You can tell by the seed number. So that number is the way that we do it is there's a constant, and then we just apply that constant to the number of acres, and that gives us our estimate. And so the 4 million bushel increase in USDA's number suggests that they think that farmers will plant more than 83 million acres of soybeans next year. And that makes a lot of sense, really, because given how tight soybean stocks are, and if the corn crop is what it's supposed to be, we should rebuild U.S. corn stocks sufficiently that farmers can plant more soybeans. Now, the bulk of their decision will still be up to their crop rotation and other considerations, but it would be really surprising, especially if crush demand is as strong as we expect it to be, for farmers not to plant more soybeans next summer or next spring, I suppose. All right, USDA's stocks report came out. We didn't really talk too much about it. When the stocks report comes out, we basically have almost all of the data except for just a little bit of trade data, essentially. And so the only piece of data that we really don't have any idea about is the residual usage for the quarter. And residual usage is, there can be several things that residual usage is. Early in the year, the best way to think about residual usage is sort of, because we're exporting and crushing a lot of soybeans are being transported. And those beans that are being transported don't count. They don't show up in the stocks data. And so then when they show up in the usage data in the next quarter, it's like use from out of nowhere, which then shows up as sort of negative residual use. So in the first quarter, typically residual use is very high because we're shipping so many more beans that apparent consumption is higher than it actually is. And then in the following quarters, that process reverses, and we sort of find the beans back that we lost in the first quarter. So it's something that we look at every time there's a stocks report, because it's a decent way to estimate the changes or the quarterly residual. However, if you put an R-squared on this, you probably aren't that high. This relationship is not that great, and the relationships kind of get worse and worse as you move through the year. In addition, in the fourth quarter, USDA also, like I said, revises their crop production from the prior year. And so the fourth quarter's residual use is some combination of that crop change and then the difference in exports. And while it's not the world's best predictor, you can see that over the last 5 years, which are the dots in red, there's definitely a trend. And I would have thought that this year would have been relatively similar. However, you can see from the purple dot that this year, the residual use was significantly more negative than the change in export inspections would have implied. And so that means that either the adjustment in the crop last year, which wasn't that large, didn't really capture all of the adjustment, or there are some exports that we found back that we didn't know we had before, or the problem with residual use ultimately is that it can almost be anything that you want it to be. Realistically, it's about the beans in transit that we don't see in the first quarter, finding those back in subsequent quarters. So what I'm about to say is something that actually is true, but it's not something that I would bet a ton of money on. But it's still there, and I needed a slide after the soybean balance sheet. And so realistically, just based on this relationship, which again, I wouldn't do this, but I'm showing it to you. You could say that maybe USDA's revision of last year's crop was 40 million bushels too small. So they needed to lower the crop more, which would have offset the negative residual use and moved the purple dot higher. USDA is not going to do that. They will adjust stocks probably by a relatively small amount in the next quarter or two, the 22-23 ending stocks, but that'll be it. And so there's almost zero chance that they will adjust by 40 million bushels. However, it still is something that is a little odd, and so I wanted to point it out. Onto soybean oil, I think USDA is going to need to make a massive adjustment to its U.S. old crop 22-23 balance sheets. So if you look, the main differences really at this point, and again, we have almost all of the data, are non-biofuel use and biofuel feedstock demand. That makes sense since they are two sides of the same coin. However, USDA, I think, is going to need to reallocate 500 million pounds from biofuel feedstock use to non-biofuel use. Now, our biofuel feedstock demand forecasts, we know, tend to generally run a little high. And so we set them and then we kind of end up coming down throughout the year. USDA tends to, or at least historically, has taken the opposite approach, where theirs have come in low and then they've raised them a little bit throughout the year. And you can see that in 23-24, where they're at 12.5 and we're at 15. I think 15 is probably a little too optimistic, but I think 12.5 is a little too pessimistic. And by the time it's done, I would be surprised if 12.5 and 23-24 didn't imply steady or a slight decrease in usage from 22-23 to 23-24. For non-biofuel use, so if our feedstock forecast is always a little high, what I can't really come on here and tell you is, hey, look, we've used 1.2 billion plus pounds of soybean oil in biofuel production in the last couple of months. Our 12.5 billion pound forecast suggests that the last 2 months of the marketing year will be in line with the prior 2 months. So we're about 1.2. I think we're even a little bit lower than last month's usage for the final 2 months. So that's not a stretch, but again, given that we're generally high, I don't know that I would trust that number. Uh, However, for non-biofuel use, there's only basically 1 month well, there's still 2 months of data, but we have sort of an implied number for one of the months, and so there's less room for error there. And because it's a residual and not sort of a forecast number, because it's just the remaining usage that's not accounted for by exports or biodiesel feedstock demand, it tends to be a little bit more accurate, I guess. Uh, so with only 1 month left, our 14.1 billion pound forecast implies non-biofuel usage in that final month of 1.1 billion pounds, which is very much in line with where it's been for most of the year and certainly over the last couple of months. And to get to USDA's number, that number would need to be 1.6 billion pounds, which would be record large by a fairly long shot. Record large, I guess. There was probably a time way back when we were using 16 or 17 billion pounds of soybean oil in non-biofuel usage. There's probably a month in there with 1.6 or more, but certainly in recent times, 1.6 would be the largest by a long shot. And so it seems really, really unlikely, especially we haven't hit 1.6 in the last several years for sure. So USDA is going to need to make this big adjustment. You can see they started a little bit last month, but they're going to need to get that going significantly quicker. Next, at the beginning of November, we'll get the final fats and oils report. That'll give us the 22-23 ending stocks, and from there then it's just allocating the usage. We know exports are nothing, and so it's just that split between non-biofuel and biofuel. And I think by then they will need to be a lot closer to where we are than where they are now. So I would expect probably a pretty significant change this quarter or this month, and then depending on how much they do this month, or I suppose don't do this month, then next month they probably will need to do whatever is left in there. For next year, again, it's the same difference, and it's what I've kind of talked about, because our feedstock use forecast, which may be a little high, but we don't think is an unreasonable way to estimate or to predict feedstock demand. Because that's so high, our non-biofuel numbers a little low. Again, those probably will come a little bit closer towards each other as we go through the year. And then the only other real difference outside of sort of we've got larger production because we got more crush, but the only other difference really is down to ending stocks. That's partially just a carryover basically from old crop. And so we've got stocks down at 1.57 and USDA's at 1.86, and we've got them tightening a little bit. So does USDA. So thematically, the balance sheets are the same. They're just starting at different levels, and then they go through and have roughly the same amount of use relative to supply. The details again will vary a little bit as we go through the marketing year, but I don't know that I expect USDA to make a lot of changes to their new crop balance sheet unless they cut soybean production so much that they start to cut into crush a little bit more, and then then that will reduce supply, and then they'll make whatever changes they think make sense based on that reduced supply. I would expect them probably to hold fairly tight on, if let's say that they do cut soybean production and they do cut crush, so soybean oil production is a little lower. I would expect them to take that out of non-biofuel as opposed to out of biofuel feedstock demand, given the fact that it looks like at least their current estimate or their September estimate would be unchanged from this year. All right. So one of the things that I wanted to talk a little bit more about is the recent moves in soybean oil and fats and greases. Soybean oil futures have rallied back and are now only down about a penny, and that follows. I think they were down. They were certainly down more than a cent yesterday, and they were down about a cent and a half. I think at the low today. We haven't yet seen the same move in the fats and greases. And so it's a little hard to see on here, but the data points just before where we get to our forecast are the September averages. And you can see that the spread between soybean oil and the fat and greases generally all moved to tighten in September. The only exception to that was choice weight grease. I think part of the move in choice weight grease may have been due a little bit to maybe to USDA's adjustments in their feedstock use that came out a couple months ago. They came out at the end of August. I don't know that that's really it. That data is kind of old. It's a couple of months old. People in the cash market should have known and factored that in anyway, just based on their transactions. So I think the revisions are more for analysts than they are for cash market traders. However, choice weight grease has been a bit of an odd duck in the feedstock markets since renewable diesel has really taken off. It's been a little surprising that choice weight grease hasn't been more popular. Now, the changes EIA made to the feedstock usage data helped alleviate some of that. Choice weight grease, I think, had the biggest changes, if I'm remembering correctly. Maybe I'm not. But it still is not nearly as popular as tallow or some of the other feedstocks. So it's been a little strange, but it looks like it's headed down relative to soybean oil. Up on this chart means down relative to soybean oil. We expect that this trend will continue in 2024, given what appears to be relatively weak or bearish world vegetable oil fundamentals, and the tightening of the domestic fat and grease supply that should continue to narrow the spread or push, as we're sort of expecting here, several of the commodities to trade at a premium to soybean oil. So tallow, DCO, and poultry fat, I guess, are the three that we're predicting will trade at a premium to soybean oil over the next year, or I guess over the next 14 months or 15 months. We'll see. I mean, it's not impossible. Tallow is apparently already tallow and DCO are already premium to soybean oil. That may be in part sort of we're comparing crude soybean oil here, so it might be a spec thing, although I don't think that would necessarily be the case. But I think that this probably is going to be something that these relationships are going to be something that become more and more important, especially, of course, as we move in transition from the blender's tax credit to the Inflation Reduction Act credit. That should get us it should push prices more in the direction of sort of CI parity. I've explained a lot of times why I don't think we'll actually get to CI parity, but I think it should at the least sort of push prices closer to that level. For canola, the biggest change I think that USDA is going to need to make is they're going to need to cut their estimate of Canadian canola production. Stats Canada's latest estimate is 17.4 essentially million tons. and USDA is almost 1 million above their September estimate was almost 1 million above there. Again, like last year, I would expect more of the reduction in production to come out of exports than I would out of crush. However, our crush forecast is already below USDA's, and so it wouldn't necessarily surprise me if they cut by the full nearly 900,000 tons. That they wouldn't split that up a little bit and probably be. I don't know if they would go quite as low as we are on crush right now. So they might take their exports down a little bit lower. But whatever that changes probably will be sort of their last or very close to the last change that they make in terms of cutting crush because of a change in production, mostly because this will be the I think Stats Canada does another crop estimate in December, and I think that'll be the last one for this crop year. And so there won't be a lot more changes to come, mostly. And once they get down close to 17 million, then they will be done. And the commentary on this one, but it was sort of supposed to say was that if you looked at the just the yield, the implied change from the yield from 23-24 based on the increase in acreage, actually just based on the yield, production could have been down at about another 500,000 tons, which puts into perspective how bad last year's drought may have been. If you look back, the year before that, weather was generally supportive. In 21-22 was when the drought was really bad, and this would be better than that, but certainly more than 2 million tons below last year, which was kind of normal growing conditions. And so I think that's important because at some point, it may be that if droughts become more frequent, it may be that growth in canola acreage expansion slows. Of course, there's a lot of demand for vegetable oil, and so oilseed area probably will expand in North America over the next couple of years. But that said, as they showed this year, I think farmers are very, very sensitive to anything that looks like it will impact their income, of course. And a couple of years of droughts will get farmers to not necessarily abandon canola planting. That will never happen, but certainly minimize it until, or at least shift it a little bit until they're more confident that the weather pattern is going to support the return that they're expecting when they plant the crop. So they plant the crop, they expect so many tons per hectare, and they have some range of a price that they expect, and then that's kind of their income. And if drought comes and reduces that by 20%, that's significant and it hurts. And if they think that there's another crop that might do better in conditions that are a little more droughty than they have been historically, they will favor that crop over canola. Again, I don't know that this is going to happen, and given the fundamentals in the North American market, it seems less likely to happen. But it was something that I was kind of thinking about as I was looking at the yields when I made the changes to our balance sheets. And then this shows the production and the yield. I just wanted to hit this yield one more time. So outside of the really, really bad drought, this yield is the lowest it's been since 14-15. And if you look, the yield kind of has gone through a couple of steps up here, or maybe one step. The lowest step is here through like 04-05, and then from 05-06 through 12, 13 is another step. And then from there on is a third higher step. And this would be, again, other than the drought 2 years ago, this would essentially be the tied for the lowest yield in that upper step. And so if we think about a recovery in production in South America, the US not having ideal conditions this year, Canada definitely not having ideal conditions this year, and then both of those areas recovering, Canada producing more canola seed next year, the US producing more soybeans next year, it's hard to get very bullish on soybeans or prices in the soybean complex, including soybean oil. And I still think that fair value for soybean oil is probably somewhere between 50 and 55 cents. But we could certainly test the lower end of the range that we established earlier this year below 50 cents. Just given the size of the current move and what's going on with the fundamentals, this feels like it's probably there's more room to run here over the next several months. Again, in the short term, it feels like soybean oil prices have been pummeled and you might get a little bit of a relief rally, but I wouldn't expect that to be the beginning of a new trend. I would think that would be just a little bit of a recovery in a broader bear market for vegetable oil prices. And the recovery in oilseed production in South America and then in North America next summer, I think will kind of add pressure to that. On the other side, of course, is the growth in feedstock demand and tightening soybean oil supplies and so tightening vegetable oil supplies. So again, I still think that it's the basis that is gonna ultimately sort of solve that issue of world prices coming down, but really strong domestic U.S. fundamentals. But even that hasn't quite worked out the way that I thought it would here recently. For canola oil, our balance sheet in USDAs are relatively similar. USDA doesn't always make changes to their Canadian canola oil balance sheets every month. And so I never quite know to say, oh, I think this is the month that USDA is really going to make a lot of these changes. They do have some differences with us, but it's a little hard to make a comparison because, of course, the biggest difference is in our stocks number. We reconcile to a different number than USDA does. And so because of that, USDA has much higher stock levels than we do. And they also, in theory, can export more or use more domestically and draw those stocks down a little bit, whereas our stocks are relatively tight, and so we can't really necessarily do that. Again, domestic use is our biggest disagreement with them. On this one, I assume that it's a little bit more probably non-biofuel use than biofuel use. We haven't seen we haven't seen demand for feedstock in Canada that was as strong as I would have thought it would have been, not necessarily because of some big analysis that I did that said, oh, this is what I think demand's going to be, and then it's not that strong. Much more just sort of the volume or the amount of sorry, I lost that thought. It's much more that I expected really strong usage because of the experience that we had in the US. And of course, the Canadian biofuel industry was not expanding or is not expanding as quickly as the US biofuel industry. So usage would not necessarily be significantly different. Still, despite that, and I kind of understood that, but still, when we really set up our Canadian feedstock balance sheets and in our model for Canadian feedstock consumption, it was our estimates and predictions were a little lower than I had expected as well. So I say all that to say that I think USDA needs to raise their domestic use, both old crop and new crop. But I don't necessarily know that this is the month that they're going to do it, or that there is necessarily a big trigger. Now, if they do adjust their Canadian canola production forecast, then they will also adjust their canola oil balance sheet. And so that does argue for maybe a better chance that they make some significant revisions this month than in next month. And this is just our forecast for Canadian canola oil exports. You can see it is basically right on the 5-year average line. We use the 5-year average for seasonality, and the 5-year average turns out to be very close to our forecast for this year of 3.1 million tons of Canadian canola oil exports. The vast majority of those go to the U.S. For August, Canada shipped 261,000 tons. And 239,000 of those went to the U.S. And that's not uncommon. There are certainly months where the U.S. doesn't represent more than 90% of total shipments, but it's very rare to see another country have really significant imports from Canada. And of course, that makes sense. We're right across the border from them and have really strong demand for canola oil, particularly right now. We'll see how this goes. A lot of this, again, will depend on the ultimate size of the Canadian crop. If it's close to where Stats Canada's latest estimate was, then this number is probably going to be relatively close. If there are bigger adjustments, lower or higher, I suppose, coming in the December report, then I would probably raise or lower this number as I adjusted the crush. But sort of like the U.S., I probably would add more to exports first and then add a little bit to crush, sort of the opposite direction when I'm cutting crush in Canada. Finally, Malaysia. The USDA numbers are not that important for palm oil. And so I put this up mostly to show that where our estimate of ending stocks is or was before the MPOB report, that data came out. Well, the next slide is a summary of that. This was before that came out, and what I wanted to show here was we really are going to end up around 2.3 million tons. That is close to what the MPOB reported on last night, I guess. However, next year is kind of potentially not going to be as bearish as this year has been. And that's because the El Nino also tends to dry out Southeast Asia, and limited rainfall in palm growing regions will ultimately impact production. We still have production going up, and we have demand that is a bit stronger. It will be interesting to see if the demand number in exports actually comes true. I was going through the cargo surveyor data, and one of the things that I noticed was that one, you've had demand from China and India slow a bit. At the same time, of course, like we've talked about, you've had imports into the US growing. The US imports are not significant enough or even close to significant enough to offset the decreases in China and India. Each of them import 2 or 3 times as much palm oil from Malaysia as the US does in any given month. So while the US imports are are an important factor and important for Malaysian producers going forward. They're not going to be so strong that they reverse the market. However, if you think of palm oil and you think of part of the reason that people don't want to use palm oil anymore is because they're worried about the deforestation that occurred to expand palm oil production. And that concern has been something that's been around for several years at least, and back further than that, I'm sure. And I think you could probably make the argument that that whatever impact those concerns were going to have on palm oil demand, it probably already happened. So I don't know that we're going to see a lot more downside in exports. I also don't know that we're going to see a lot more growth. And so kind of what I wrote this week was basically, if that is true, if it's been the concerns about the environment that have limited palm oil demand in recent years, we're probably getting down close to sort of fully realizing whatever that impact is going to be. And it looks like if that's the case, that demand is roughly 15.5 million tons. Export demand is roughly 15.5 million tons. And if it stabilizes around that area, which is what it looks like it's done over the last several years, certainly, then it should start to grow slowly with economic growth and population growth as we go forward. I don't know that that's enough to get 1 million tons of exports back next year. However, given the growth that we expect in U.S. imports and slower growth in broader import or bigger imports for India and in China, we could get back to the 16.5. And if we do, that's really key, because that would ultimately imply probably that ending stocks fall below the 2 million ton level, which also in theory then implies higher palm oil prices. Now, we also expect nearly 1 million ton increase in production, which if El Nino is really bad and it doesn't rain, we won't see an impact on that until we get out of the seasonal decline in production. But the second half of next year will be a direct result of the rain over the next several months. And so if that's restricted, the production might not be as strong as we think, or the change in production might not be as large as we think. And that could offset any shortfall in export demand. Similarly, I think we probably need to raise our domestic use from the 3.8 where it is now. It's in line with where we are this year. And so I wouldn't raise it a lot, but maybe just a little bit more. And again, it's just another little bit that might help offset the 16.5 million tons of exports if they don't get there. Okay, so here is a summary of Malaysian Palm Oil Board report. And basically what this really tells us is that, export demand is really weak. So the 1.2 million tons of shipments in September was the lowest for September since 2005. And the total for the year was the lowest in the last several years. India has been sort of, India and Malaysia go back and forth about veg oil and imports, and India's put tariffs on imports. India's basically trying to protect the domestic refining industry, so a lot of their tariffs are more focused on refining than they are on just imports. But there's a little bit of back and forth there, and so you kind of always, I never want to say like, oh, India is going to be really strong this year, or India is going to be really weak this year, because there's always that element of it that you kind of never know what they're going to do or how that's going to impact their demand for Malaysian palm oil. China, on the other hand, is a little bit more straightforward. And I think that most of the slowdown that we've seen in Chinese imports is just due to the fact that it's taken their economy longer to come back from COVID than everybody expected. You did start to see a little bit of a rally in crude oil prices, I think in part because while there are broader concerns about China's economy than it coming back slowly after the pandemic, it still is a really large vegetable oil importer, and I think that there is a good chance that Chinese imports start to accelerate a little bit next year. However, if we have all of this soybean oil that's potentially available from South America, and if the sort of the basis or the I guess Argentinian flat prices are a better indicator of where world prices are than U.S. prices, it may be that China is more interested in buying soybean oil out of South America than palm oil out of Malaysia. And I think that'll be one thing that will have a big impact on whether we make that 16.5 million number and whether we end up with ending stocks that are 2 million tons or below or above 2 million tons. All right. Now, the last thing that I want to talk about, and I know this is a little bit busy, but I didn't want to keep looking down at my notes, basically. What this is trying to do is, in a very not well organized way, compare the profitability of producing both biodiesel and renewable diesel out of either vegetable oil or fats and greases. And then the other thing that I want to talk about here is the decline in RIN prices and the impact that that has on margins relative to the impact that that movement in feedstock prices has. So recently, there have been some anecdotal reports that suggest that a large biomass-based diesel producer in the U.S. is going to shut down a couple of its plants, cut production at its other plants to 50%, except for one. And that's basically a reduction. If they do that, they didn't really talk about which plants, or I haven't really heard which plants. But if we assume that they sort of shut down the smallest two plants that they have and then cut production by 50% at their other plants, save for the one plant that will just stay going, it implies about 225 million gallons of reduced biodiesel production. And so that is, depending on the exact conversion rate that you use, we'll use 8 just to make the math kind of easy, based on the idea that it's 8 pounds of soybean oil. I think that's a little heavy, but it's 8 pounds of soybean oil per gallon of biodiesel or renewable diesel. And soybean oil is about 40% of the feedstock mix. That suggests, although the actual result will depend entirely on their particular feedstock mix, but it suggests about 700 million pounds of demand, soybean oil demand that's lost, and that probably has a lot to do with what's going on in soybean oil futures and soybean oil basis. And I imagine that by the time that anecdotal reports are starting to make their way around the market, this is probably something that they've been planning for a little while and that they probably knew and some of their suppliers knew was going to happen. And so it may have contributed to some of the recent weakness in soybean oil. And certainly also they probably wouldn't be buying ahead for their production. So that announcement or those reports, I suppose, made me think, well, given what we're showing for margins, that doesn't really make a lot of sense to us. And so is it that we are just wildly off on our margin calculation, or is it something else, or are the anecdotal reports just wrong, which is also a possibility. And so I kind of put this together in part just trying to answer that question in my own mind, But then when I did it, I thought, well, it's kind of interesting. And we can also talk a little bit about what's been going on in the RIN market and the relative impact of the decrease in RIN prices versus decrease in feedstock costs. So RIN prices continue to plunge. I think we took our forecast down we took them down below 100 this week for sure, for both D4 and D6. That's a big stretch since prices have already fallen below 100 and below 90 as of yesterday, as far as I know. We are still in a spot where in some of the months, the D6 is still supporting the D4. However, they're both falling so fast now that we can kind of move the D6 down to a spot that is maybe a little bit lower than the model would suggest. And that gives us some room to move D4 down. And then the whole forecast kind of looks better when we do that. I would say that I think that given the move we've seen in RIN prices, it would be nice to say that that the move was over or close to over. But given again what we've seen in soybean oil, if RIN prices are well correlated to feedstock costs, the decline in soybean oil will probably continue to pressure RIN prices. On the other hand, we haven't seen the same size moves lower in fat and grease prices. Now we are starting to see fat and grease prices come down a little bit. And the last week's break in energy prices, which took crude down by 10% in 2 days, pressured or at least narrowed margins. However, feedstock costs were falling at the same time. And so again, margins remain relatively robust. So it's a little curious to me why this company would decide to do this right now. If RIN prices are going down, I understand that that can impact margins, but unless our calculations are wildly wrong, then margins should be relatively good. And even if you don't trust my calculations, the fact that RIN prices are falling should mean that margins are good or that we have enough production. The other possibility for driving RIN prices lower is the overproduction that we're seeing this year. While it's not out of line with what we've seen historically, over the last 3 years, we've sort of underproduced, and so overproducing may feel a lot different to traders this year. Or the market is just getting much more sophisticated and started to look at the 2 billion RINs of carryover and is essentially asking the industry, why are you carrying 2 billion extra RINs from year to year? That's $2 billion. But whether you think RIN prices are falling because of feedstock costs or falling because of relatively high historical margins, the RINs are meant to be an insurance policy effectively for margins. So the fact that they're falling suggests, if you know nothing else, suggests that that margins are probably relatively good. It would be hard to have RIN prices falling and margins terrible at the same time, because that would imply less production, fewer RINs. RIN prices should be supported. There is one other possibility, and that is that with the excitement around the expansion of renewable diesel capacity over the last couple of years, everything got kind of inflated. And so as the markets work their way back towards the new equilibrium, all of the markets would essentially do that. So soybean oil on some level feels like it's doing that now. And from a time perspective, it's also kind of the time that we usually go back to the new equilibrium. RIN prices might be doing the same thing. So while we did underproduce the last 3 years, for some chunk of that, we didn't even know what the mandates were. And so the RIN prices that we saw, the record high RIN prices that we've seen over the last couple of years, could certainly be, at least in part, a function of the shortfall in RIN production relative to the mandate and the ethanol gap and the UAB and all of that. But it also may just have been part of the excitement about the growth in the industry, and that excitement is now coming out of the market. And in that case, then pretty much the fundamentals just don't matter anymore, and you can just really concentrate on where you think fair value is for each market, and that then becomes kind of your target, no matter what the fundamentals say. I don't know that that's it 100%, but I think it's some combination of those three. You've got at least a big chunk of the feedstock cost falling pretty rapidly. You've got production at or above the volumes it needs to be to meet the mandates, and then you also have sort of this speculative excess coming out of the markets. So I think that's all three could be contributing to the sell-off in RINs, and really, I think if you only had one, you probably wouldn't see as dramatic a sell-off as we've seen. It's starting to feel like people are really starting to panic on RIN prices. And so while I was thinking about, okay, well, if RIN prices are coming down, sort of that just alone kind of tells you that margins should be okay, or at the very least, potentially getting better. Why would you close down at this point if that's true? And I think there's a couple of things. One, I think there is the potential for the feedstock mix in those facilities to be more fats and greases than vegetable oils. And so maybe their margins are closer to the fat and grease margins than the vegetable oil margins. And while that is a significant difference between those two, it still would suggest relatively good margins, at least based on our feedstock mix of tallow, UCO, and DCO. And if RIN prices are coming down because we've overproduced, or because feedstock costs are falling, the removal of some biodiesel capacity would have some impact, but probably not a huge impact on the overproduction. And if it's just because soybean oil prices are falling, if that's what's driving RIN prices down, and you're closing plants, it seems really unlikely that conditions in terms of the difference between energy prices and feedstock costs are going to get a lot better in the coming months or the coming year. We're at a spot where, yeah, soybean oil prices are really high, but so are diesel prices, or biodiesel, renewable diesel prices. So the margin seems good. So it is confusing why we got that announcement and what happens next. If that announcement is the start of a broader trend, then we finally will get to the point where we have rationalized some biodiesel capacity. I don't know that I think that that's true, and I don't know what would happen to the 225 million gallons of productive capacity if that is the case. Because if that's the case, you're shutting it down now, things aren't going to get better. Not that they're terrible now, or even the best now, but they're unlikely to get better. And so if you're shutting down waiting for things to get better, that's going to be a long wait. And it all just is very, I think, strange. I don't quite get it, and especially based on our calculation of the feedstock costs here. And I've laid this out to try. It's not labeled very well. I apologize. Basically, the above the top double lines is income, or above the first double line above this. I don't know if you can see my pointer or not, but above the very top double line is income. Above the next double line is costs, and then below that line is the profitability. The left-hand side is fats and greases, and the right-hand side is vegetable oil. And the last thing that I want to say about this, and then I'll get to what I really hope are questions and not the fact that I haven't been sharing my screen, are that for every penny drop in the RIN price, you get about a cent and a half decrease in margins. For every penny drop you get in feedstock costs, you get a 7 or 8 cent increase in margins. Now it's harder for feedstocks to drop a penny. For soybean oil to drop a penny, even today, that's still a big deal for soybean oil futures to fall a penny. So I'm not trying to pretend like, oh, well, for every decrease in RIN, for every cent decrease in RIN prices, we've had a cent decrease in feedstock costs. That's not true for fats and greases for sure. For soybean oil, we've come down 10 cents or so in the past month or so. So it's a little bit true for that, but it still isn't. We've basically almost cut RIN prices in half over the last year or so. So even that 10 cents, it would take a significant portion suck up a significant portion of that decline in RINs, but RINs would still be ahead. If we compared prices for feedstocks versus when RIN prices peaked, I think the decline in feedstock prices would more than offset the decline in RIN prices. So while RINs are important and they are critical for the industry to be profitable, the impact that day-to-day changes in the price don't have that significant an impact on margins. And even then, you still have to sort of go back and look and say, okay, well, what did feedstock costs do, or what did fuel costs do? And are they offsetting the changes in RINs? And I would argue that they probably are close to offsetting the changes in RINs and maybe a portion of the changes in the LCFS credit as well. All right, with that, hopefully this isn't like last week. All right, the fast market forecast for soybean oil use in food, non-biofuel use is significantly lower in 23-24 than the typical annual use. Will this be achieved by rationing or from switching oils? So it really will be achieved more by switching oils than rationing, especially if we are in this sort of move back down to the new longer term equilibrium. So if that's what we're doing, then it's unlikely that without a crop disaster, if we have a drought in South America this winter, or a drought in the US or North America next summer, then soybean oil prices can go wherever they can go, assuming that doesn't happen. And we are sort of settling back into the longer term equilibrium. It doesn't argue that soybean oil prices are going to rally back to 90 anytime soon. So what will happen probably more frequently is, and it's part of sort of the increase in palm oil imports, the strong demand for canola oil, is there will be some substitution of canola oil in the food industry and some substitution of palm oil in the feed industry. That will offset some of the decline in soybean oil use. Now, the big decline year over year in non-biofuel use is partially just a function of, we have this much supply. This is what we think the feedstock demand is. Whatever's left is mostly for mostly for non-biofuel. There's a little bit of exports in there, but the rest of it goes to non-bio. And so just sort of whatever is left is kind of the 12.5. So we come at it from the top down, as opposed to kind of saying, okay, how many food manufacturers are there in the United States? How much vegetable oil do they use in building it up that way? So I think I say that because I think that the total probably will be a little bit higher than 12.5. I think, like I said, our feedstock use will probably be a little lower. So I think that decrease will probably be a little bit smaller. And I don't know that we will have to drive soybean oil prices up high enough to ration demand. That said, again, I think that given the setup with falling flat prices, I do think that basis in the US probably at some point will will stabilize, and depending on how tight the market is domestically, could start to go up. So that could ultimately lead to maybe a little bit of rationing, but it's more likely that it leads to more switching. And the last couple of years in the spread between soybean oil and almost every other oil has done a lot of the work of convincing end users to that switching might not be a bad idea. Now, they are just like the buyers that aren't necessarily buying from Argentina, even though it may make economic sense to do so. They will have considered the impact on their relationships and all of those other things very, very carefully before they start to switch. And there's a whole host of things that they'll have to do to switch. And so that'll mitigate it a little bit. And certainly sort of in the food industry, taste concerns and all of those things, it's very complicated to switch oils. And on top of it, most non-biofuel users can afford to pay more than biofuel users. However, the biofuel users are mandated by law, and so they have to use what they have to use. Whereas the non-biofuel can switch. And so there's been enough time, and the difference seems to be large enough and maybe persistent enough that we'll see, I think, again, more switching than rationing. Do you expect the lower soybean oil prices are pushing down D4 RINs and consequently D6 RIN prices, since biomass-based diesel is being used to also meet D6 RIN requirements? I go back and forth on this one. Honestly, it's the question that I get most frequently at this point. And like I said earlier in the year, I think this is the year that we could see the supply and demand of RINs actually have an impact on RIN prices. And that seems to be what's happening. It also seems to be, given what we've seen in soybean oil, it seems to be related to soybean oil. However, the only hesitation that I have in saying that, oh yeah, it's just RIN prices being well correlated with feedstock costs. The only hesitation I have in saying that is that you haven't seen the same moves in fats and greases. Maybe the RIN mark is anticipating that move in fats and greases, and certainly we have started to see some of the fat and grease prices start to roll over a bit and start to move lower. And if they follow soybean oil, then RIN prices, I suppose, and if they follow soybean oil and that's what's driving RIN prices lower, they could have further to go. However, given just the plunge in RIN prices, it doesn't necessarily feel like it's feedstock related. And I think that it feels a little more like it's being driven by the oversupply. That said, you can't ignore the correlation between soybean oil and RIN prices, and since that is the driving force behind RIN prices for the vast majority of time that they've traded, I'm going to stick with that answer right now so I can actually give you an answer instead of just kind of talking around it the whole time. I'll say that it's soybean oil, but I'm still keeping an open mind towards the idea that it's the supply of RINs. I'm not 100% sure exactly how we're going to figure out which one it is if soybean oil keeps going down the way that it's going down. But just the violence of the move, really in both of them, but the violence of the move in RINs lower makes me think that it's something more than just falling feedstock prices, because feedstock prices can go back up too, right? So will the presentation be shared? Yep. If you want a copy of the presentation, please send me an email and I will try and get it out to you in the next day or two. Do you mind repeating how much renewable diesel reduction you expect from the major producer? 225 million gallons, roughly. based on what we've heard. Now, again, they're anecdotal reports, so take them with a big grain of salt. It feels as though the RIN slide is due largely to the overgeneration of credits relative to the mandate. Seems we could be on track for 2+ billion oversupply this year. On top of that, the incremental generation is coming from obligated parties. For example, or I guess that's actually, in other words, refiners who might not have the same incentives as traditional producers. They want to offset their RIN liability and may continue running even at a loss, since the net back on their traditional refining business benefits from lower RIN prices. That's an interesting observation, I've got to say. Yeah, driving RIN prices down would make their other refining more profitable, because effectively they're buying RINs to meet their obligations, and so lower RIN prices mean lower costs. Yeah, I don't really disagree with this. I don't. I said soybean oil to answer the previous question, and I'll stick by that. But it is, again, it does feel like this is different than other years, and it feels like this may be more related to the oversupply than the fallen feedstock costs. However, the one thing that really gives me pause about that is that other than the last 3 years, we've always overproduced. And the industry, like I said, has always carried, almost a full year's worth of RINs. The other things that make the supply argument a little less likely, I guess, are the fact that the RINs expire. You can use them in different years, and some of them don't count because the biomass-based diesel is exported. And so for all of those reasons, the supply that you see from the EMTS data isn't necessarily the supply that actually gets counted in the end. And it also sort of messes up the traditional supply and demand relationship with price that we see. So again, it feels different this year, and at the end of the day, if I figure out if there's something that I can point to and really say, okay, here it is, it's because of the oversupply, I will be happy to point that out. I don't have a preference one way or the other, whether it's oversupply or feedstock costs. And it may be oversupply. But right now, like I said, I'm sort of sticking with feedstock costs. On your last slide, do the credit values include California LCFS credits? If not, how do you get it? Yeah, no, they do. They include the LCFS credits. Sorry, there is a little section down there that shows the credit values. It's not super greatly organized. I apologize. I'll try and do that better in better organization, and maybe show that every once in a while, because it does provide at least a little bit more insight into the profitability of each of the fuels than just the single feedstock mix that we have. Now, it's still a feedstock mix, we assume. So, and finally, my email address is just my name, Torrey, T-O-R-E .Alden, so Torrey period, Alden, A-L-D as in dog, E-N, @fastmarkets.com. if you would like the presentation. Okay, man, I've really gone over this week. I apologize. Thank you, everybody, for attending. I really appreciate your support, and I will see everybody next week. Bye-bye.